This next period is really going to be about fundamental property investment and asset management. And what I mean by that is picking the right property in the right location, controlling expenses, keeping it occupied, being smart about the capex, and having the discipline to sell it when it's time. These are all sort of old school real estate skill characteristics. That's what's going to be rewarded in the marketplace over the next handful of years. It's not going to be taking risk and hoping for yield compression. It's going to be growing income the old-fashioned way.
Hello and welcome to the REIT Report. I'm your host, Sarah Borson-Keto. My guest today is Mike Acton, Head of Research and Strategy for North America at global real estate asset manager AEW. Mike is with me to share his thoughts on the current trends and themes he's monitoring across the commercial real estate landscape today. Mike, great to have you back on the podcast.
Great, thank you for having me.
So, Mike, to kick things off, what are the key macro factors shaping the backdrop for commercial real estate halfway through the year? And do you see any shift ahead in terms of the influence of those factors?
The main factors driving real estate always are what is the health of the economy and what's the cost of capital. In other words, what are interest rates? The U.S. economy seems pretty solid. We're in a really protracted capex investment cycle going on, building data centers, chip plants, everything related to AI. As long as that stays in place, the economy seems pretty solid. Now, the cost of capital is the open question. The last year or two, I would think a lot of investors were waiting for the Fed to start cutting interest rates again, for the long end of the curve to start coming down, get inflation under control. But we've had a lot of shocks to this economy over the last 2 years. We had a trade shock last year through the tariff issue. And this year, of course, we have the war and energy cost shocks going on. So interest rates have stayed higher, and they're likely to stay higher for some time to come. So we can't count on that anymore for near-term recovery. In the next couple of years, for real estate, it's going to be all about income growth.
And would you say that current market conditions make it a reasonable time for investors that are looking to enter the market?
Yeah, this is a very good entry point. The yields are the highest they've been in at least a decade. Most assets are trading below physical replacement costs because physical replacement costs has become so elevated from the inflation burst we've had. So those are great entry point signals, but it's not broad-based. You can't just go out and buy the market. It's not a big beta play. It's very much a sector-specific or location-specific. I would argue it's a property-specific type of market today.
So what really should investors be looking for when you say it's really that specific?
They should really be looking for places where they can underwrite solid near-term growth in property earnings. In other words, net operating income of properties. And that's not uniform. It's not uniform within a property sector. It's certainly not uniform across property sectors or even across markets.
And commercial real estate has now recorded several quarters of positive total returns, with income continuing to drive performance. What would you say that tells you about the health and durability of this recovery?
I think it tells you that real estate's doing what it's supposed to do in your portfolio. You have property in a multi-asset portfolio to give you return that mostly comes from income over time. Sure, there'll be periods in time that feel really good when you get outsized appreciation, but that's not the normal state of affairs for property. Any normal holding period, you should expect probably 70-75% of your total return to come from income. And that's exactly what property's doing today. I think that's what we have to plan on for the next couple of years. And that's a feature, not a bug, as they say. There's plenty of things in your portfolio today that are really running hot. There's going to come a time when you're really glad you have some good solid income in there as well.
And do you think that mindset is really well understood at this point?
I think it's becoming better understood. We had such a period of outsized appreciation in 2021. In 2022, coming out of COVID, you had the Federal Reserve taking interest rates down close to zero again. You had the government pumping literally trillions of dollars into the economy to stimulate final demand. And those conditions created a burst of liquidity in all asset classes, but in property, we had several years of just really extraordinary increases in property valuation. And that was wonderful while it lasted. But I think investors need to remember that when you have a burst of outsized appreciation, you inevitably get a supply response in property. And that's exactly what we saw in 2023 and in 2024. A lot of construction, particularly in industrial properties and apartment buildings.
And that supply picture is really a lot better today, would you say?
Remarkably better. We, as a country, we've built almost no retail space in over 10 years. We're building almost no office buildings today. Industrial construction has fallen really sharply over the last 2 years, and multifamily construction is just beginning to turn down. Ironically, there's some places where we're going to need new building reasonably soon.
What about adaptive reuse? We've heard a lot about that over the years. Has that really materialized?
Not as much as people had hoped, I think. Particularly, I think what you're referring to is really turning office buildings into apartment buildings. That's a very difficult lift. It's difficult in terms of just the physical aspects of it. We just saw recently in New York, one of those projects buckle under the weight of the new space added. That's an engineering problem, I suppose, that you can get around. But when you think about it, most office buildings are not in locations that have the amenities that apartment tenants are looking for. So you have that complexity, and the buildings themselves just don't lay out well in most cases for apartment buildings. So there'll be projects, they'll get a lot of attention. There'll be every mayor in every city in the United States is probably trying to do one, but that's not really going to be done at scale, I don't think.
Mike, I wanted to ask you about transaction activity, what you're seeing on that front.
Yeah, transaction activity's picked up quite a bit. It's up almost through the first half of this year. It's up almost 10% over last year. That put it about 25% over the year before. And that's all great. It's not going to get back anytime soon to the levels that we saw in 21 and in 22. But again, those were years of peak liquidity driven by the Fed, driven by federal government policy and things like that. But it's very healthy. I think everyone should take some comfort in that. But the real thing to focus on, I think, is that trades are happening at values that make sense. The underwriting makes sense. The numbers make sense relative to financing cost. And there's an old saying in the investment business that transactions are when the market tells you the truth. And so we're getting a lot more truth being told today in marketplaces. And I think that's just very healthy for everyone.
And what sort of difference are you seeing across property sectors? Are some much more active than others?
The delta, if you will, has been extraordinary in things like seniors housing. There's a lot of capital turning towards seniors because it's a story that people can understand and underwrite. Retail has come back into vogue after many years of being out of favor. So those are probably the two property sectors where you're seeing the largest increases. But we're back to pretty healthy trade volumes in things like warehouses and apartments as well.
And you mentioned senior housing, and that's really been a standout sector. What would you say makes it so attractive to investors? And do you think that can have holding power?
Yeah, the senior housing has a great story. Broadly, property values went down over a 2-year period without there being economic recession. That's the first time that's ever happened. So it's hard to underwrite economic recovery if you haven't had economic recession. Seniors housing is an outlier to that. During COVID and the year or two after COVID, senior housing experienced conditions that look and feel very much like a classic recession. Vacancy went way up, rents went way down, the NOI collapsed, that sort of thing. So right now we're enjoying true cyclical recovery in seniors housing from that. But I think everyone who looks at the sector, anyone who's been following it for any amount of time, realizes that cyclical recovery is just about to hand off to a long-term structural demand for these properties as the baby boom just begins to hit the ages where they would move into these properties. The baby boom, of course, started in 1946, exactly 80 years ago. If you look today, there's about 40% more 80-year-olds than there are 81-year-olds because there were about 50% more people born in 1946 than there were in 1945. And that rolling increase just goes on for years to come. So there's a lot of growth to underwrite in the sector, and I think that's why there's so much interest in it.
And what about the affordability of senior housing? So much of what I've seen is very nice high-end properties. Is there a range of assets that could fit sort of different lifestyles?
You're absolutely right. The senior housing as currently configured probably is appealing to a higher income population, a higher wealth demographic. There is range within that, of course, but it's all only affordable to people certainly in the top half of the income distribution. I would argue probably more in the top quartile. I think there's a real opportunity there for someone to figure out how to deliver a quality experience at a more moderate price point, but I don't think anyone's really cracked the code on that just yet. But we have about 70 million baby boomers hurtling towards these ages. There's going to be a lot of demand. We're going to have to figure out a lot of things for this population. One of them is housing solutions.
And as you look to the second half of this year, what other key themes might you be paying attention to?
Obviously, you have to focus on all the exogenous things that are going on. Is the war ending? Is the oil flow resuming? Is that going to normalize inflation and things like that? But that's hopefully a transitory sort of thing. As always, you got to keep your eye on the underlying fundamental economy. Property exists to serve tenants. It can only do as well as the tenants do within your properties. If the property is additive to their experience, if it helps them create higher earnings, a better retail experience, a better living experience, they'll reward the property with higher rents, and eventually those higher rents will get capitalized into the value. So it's all the things that we always care about. This next period is really going to be about fundamental property investment and asset management. And what I mean by that is picking the right property in the right location, controlling expenses, keeping it occupied, being smart about the capex, and having the discipline to sell it when it's time. These are all sort of old school real estate skill characteristics. That's what's going to be rewarded in the marketplace over the next handful of years. It's not going to be taking risk and hoping for yield compression. It's going to be growing income the old-fashioned way.
And that's the same whatever sector you're in.
I think that's right. Yeah. It's hard work, but if you do it well, it really does create value long-term. And I think this is what real estate's all about. If your return's mostly coming from income, and that income's coming from fundamental investment and asset management skill, you won't create huge value quickly, but you will grow value steadily over time. And I think that's, particularly for institutional investors, that's really what they want the asset class to do in their portfolios.
Mike, we've covered lots of ground. Anything else that we haven't touched on today?
It's an interesting time. People should be excited, but I think there's going to be a lot of dispersion by investment strategy, by investment manager. We're going to really find out who really does have those real estate skills and who, whether they knew it or not, was really just taking a lot of risk and hoping for interest rates to come down. So at AEW, we're very excited about this period.
Excellent. So in many ways, it's back to basics.
Back to basics, absolutely.
Mike, thank you so much for your time today.
Great, thank you.
And to our listeners, if you enjoyed this episode, please subscribe on your favorite podcast platform.